Boomers are working longer because they can't afford to retire, and many state and local pensions are on the brink. Should you be worried? Welcome to Investor in the Family Radio, a podcast about learning to invest. My name is Brian Bain, and I'm your host. At Investor in the Family Radio, we believe that every dollar and minute we spend is an investment in something, and together we want to make the best investments that we can, so thank you so much for joining us. And remember, our goal here is to help you learn to invest financially and in all of life. You can always find more at investorinthefamily.com and subscribe to the podcast at iTunes, Stitcher, and the Google Play Store. And as always, if you'd like detailed show notes from today's show or almost any of our shows of late, as we started doing this a few months ago, I should say, simply text the word family notes to the number 44222. That's one word, family notes to the number 44222. Or simply go to investorinthefamily.com and sign up for the email list there, and we will make sure to get you set up with links to the all the sign-up bonuses that we've come up with, including detailed show notes from today's show and many others, so be sure and do that. But again, for today's show, we're going to be talking through Randall Forsyth's Up and Down Wall Street column from Barron's magazine, and the article is dated October 17, 2016, and today is October 17th, 2016, so always fun how that works out, right? So in this, and Randall Forsyth entitled his article, No Umbrella for a Rainy Day, which I'm pretty sure is probably some kind of a Bob Dylan reference. I did not look it up, and I'm not that familiar with Bob Dylan, but he talks about Bob Dylan and a few other boomer musicians in this article, but I'm going to skip past all of that and get to the meat of it. So we're going to talk about boomers not retiring. We're going to talk about pensions being underfunded. We're going to talk about whether or not the Fed is going to let the presidential election on November 8th impact their assumed intent to raise rates in December of this year, and whether or not the continued challenges for the Chinese yuan will impact the Fed raising rates either. So let's dive in. So boomers are staying in the workforce even longer, even as labor force participation rate is at lows we have not seen since the mid-1970s. So the overall labor force participation rate in America is at lows we have not seen since the 1970s. Even so, boomers are staying in the workforce, so kind of bucking the trend there, or what appears to be a trend. Many of them are doing this out of necessity, not necessarily because they want to, but because they can't afford to retire. One reason is that many of them are still supporting adult children. Yikes. Another one is a lot of them have no retirement nest egg. 40 million working age households, that's 45% of the total, have zero retirement savings. And the labor force participation rate for people 65 and older is near 20%, which is twice that of what it was in the mid-1980s. So it basically means twice the overall percentage of people 65 and older are working now as were 30 years ago. And that number apparently significantly started increasing in the 1990s when interest rates on CDs began to shrink. So as interest income returns started to shrink, people felt the need to start working longer and save more money. So basically people have stepped up their savings to make up for the lack of interest earnings, which is the complete opposite of what the Fed wanted by lowering rates. Because by lowering rates, the Fed and other economists and academics thought, well, hey, we lower rates, and that will increase overall activity and spending in the economy. But because people wanting to retire can't get interest rate income because rates are so low, they're having to save more money, which means they're not spending that money, which means they're not helping to stimulate the economy, which means the Fed is getting the exact opposite result out of this as what they wanted. Boo. Come on. Can't we get this straight? Come on, people. So that's all not well and good. But what about the people with pensions, right? Okay, so if I'm in the public sector employee, I've got this generous assured pension that I can always rely on, right? Not necessarily. It's appearing more and more that many of these pensions may not be as certain as many people have long hoped and believed they would be, and as they've been told they would be. For example, the city of Dallas is considering cuts to their pension plan, which is currently short around $1.2 billion. They actually talked about a lot of Dallas police officers are retiring early, trying to capture their pension benefits before maybe they're cut or go away. I don't think about going away, but maybe at least cut or reduced. The Dallas Pension Fund it's built on the assumption that annual returns will be 7%. Guess what the annual returns were for the Dallas Pension Fund in last year, 2015? It lost 12.6%. Not only did it not get its assumed return of 7%, but it lost 12.6%. That is very, very bad. Moody's says that the state pension plans, I think across the country, state pension plans were short around $1.25, wait for it, trillion $1.25 trillion at the end of 2015, which amounts to 119% of collective state revenue, right? So if you take all of combined state revenues for 2015 plus 19%, and that's how big the shortfall is in state pension funds, $1.25 trillion. And it gets worse. The gap is expected to grow in coming years as the returns for plans has fallen far below their cumulative overall 7.5% annual target. So the annual target has been 7.5% for plans collectively. And guess what the earnings were in 2016? You ready? 0.52%. 0.52%. That's way off from 7.5%. And that happened in a year where we actually saw rallies in stocks and bonds. So some serious bad investing going on for these pension plans. Moody's calculates that the poor performance of pension plans will grow the shortfall to $1.75 trillion by the end of 2017. The states that are the biggest offenders, we should say, have the biggest gaps are Illinois and New Jersey. That is not new to anyone who's been following this discussion, but worth noting all the same. And contribution shortfalls and lousy investment returns are likely to even worsen the funding problems. So basically, contributions falling short and then lousy investment returns continue to make this problem worse and worse. And the burden of these shortfalls is going to fall mainly on states and localities, but some people are saying this could get bumped all the way up to Washington and become a federal problem someday, because policymakers in Washington will not want to risk a recession that would certainly take place if state and local pension in the event of a state and local pension funding crisis. So as a result, the federal government would surely swoop in to backstop the pensions that with increased expenditures monetized by the Fed. So surely, if things got bad enough, the Fed and the federal government would swoop in and cover the gaps and backstop things. And so, because policymakers would surely not want to risk a recession, but not everyone shares that view. That may be a little bit extreme for some people. Many people think that it's very possible that harsh decisions will need to be made on the state and local level in terms of finding ways to add to the deficit in these pension plans and also reducing the expected assumed annual returns, because the target of 7.5% appears to be very much out of reach in most cases. This could mean higher taxes. This could mean less money for other municipal projects, as money is having to be pulled from those projects and put toward pensions instead. And it could also mean lower pension benefits for future pensioners. So basically, going forward, the expected benefits may have to be decreased for those people retiring in the future. And so that is the outlook on pensions and the concern there. Slightly shifting now our attention back to the Fed and their look to potentially raise rates in December. Something that could throw a wrench in that plan, maybe not. Patrick Harker is the president of the Philadelphia Fed, and he raised concerns recently that political uncertainty related to the November 8th U.S. presidential elections could give the Fed reason to hold off the expected interest rate hike in December. So more reasons the Fed may want to delay their increase. Even so, the Fed fund rate is saying that there's about a 67% probability the Fed will increase rates at the in their December meeting, which is going to be December 12th and 13th of 2016. And this is also the overwhelming expectation of economists and investors. And it's technically, political conversations are not a part of the Fed decision making, but it seems like it's basically becoming a part of it, because for a while the Fed has stated they have two mandates: one, seeking full employment; two, that they are seeking stable inflation. And really, it appears that they have a third mandate, which is don't spook the markets, even if it means creating or risking asset bubbles. They don't want to spook the markets because they're so worried about what that can mean. And that's one reason why uncertainty politically could hamper their desire to raise rates in December of this year. So we'll see. Another thing that could cause a problem is that the Chinese yuan continues to weaken in relation to the dollar, even though Beijing is working to strengthen their currency, which is also weird because they're trying to strengthen their currency, which seems to be the opposite of what most developing economies are trying to do with their currencies. As we mentioned last week, Beijing is reducing their foreign exchange reserves in an attempt to strengthen their currency, but their currency continues to weaken nonetheless. And Bank of America Merrill Lynch expects the yuan to decline even further against the dollar, at least through the end of 2017. And so will the declining yuan give the Fed one more reason to not raise rates in December? So we'll continue to wait and see. But those are some of the bigger news to be aware of and updated of this week, October 17th, 2016. So we continue to watch boomers and them not being able to retire, which is not a strong sign for the economy. Concerns over funding pensions, which is not a strong sign for the economy. The potential of the Fed raising rates in December, which they want to do really bad because it's been a long time and they want to maintain credibility and they want to try to move forward away from crisis timing or crisis focused monetary policies, which have been in place for like 8 or 9 years now. They want to move away from those really bad, but that requires a healthy economy, which is really in question right now as far as how healthy it may or may not be. There's a lot of good reasons to think it's not, like the 2 major points we've already made today. There's also the concern about the presidential election, how that will affect the markets and how that will affect Fed decisions, and the concerns regarding the Chinese yuan and what that will mean. So lots of things to keep in mind this week. I hope this serves you well as you think through your investments. And I also encourage everyone to stay sober-minded. Also, like I said, don't let any of these things panic you. And we hope that you will continue to be a non-irrational and non-emotional investor and stick to your investing game plan. But hopefully this information will be informative as you do so. So as always, thanks for joining us here at Invest in the Family Radio. I hope you enjoyed today's discussion about Randall Forsyth's Up and Down Wall Street column from Barron's magazine. If you'd like notes from this episode, simply text the word family notes to the number 44222 or visit us at investinthefamily.com and see our notes there. And also sign up for the email list and have even more detailed notes emailed to you as well. Don't forget to subscribe at iTunes, Stitcher, and the Google Play Store. This is Brian, and thanks for joining the family. The information and opinions contained on this podcast are for educational purposes only. The information does not consider the economic status or risk profile of any specific person. The information and opinions expressed should not be construed as investment trading advice and does not constitute an offer or an invitation to make an offer to buy and sell securities.